Intel just lost 5% of its market value in a single trading session, and the explanation you'll hear on financial television is going to be incomplete. Today's drop is not just about one bad data point. It is the market finally acknowledging something that the balance sheet has been quietly signaling for 18 months. The real question isn't why Intel fell today. The real question is whether the structural forces behind this move have already been fully priced in, or whether 5% is just the beginning of a much longer repricing. Let's start with the mechanics of what happened today, because understanding the immediate trigger matters before you assess whether the reaction is rational. Intel's 5.3% decline came on volume that was roughly 2.5 times its 30-day average. That's not retail panic selling. When you see volume spikes of that magnitude, institutional desks are repositioning. Something in the forward guidance or the competitive landscape shifted enough that large allocators decided today was the day to reduce exposure. The proximate cause centers on Intel's most recent foundry update, which revised timeline expectations for their 18A process node, the fabrication technology that was supposed to be Intel's comeback story in the domestic manufacturing race. Any delay or ambiguity in that roadmap is not a minor footnote. It is the core thesis for bulls who held through the last 2 years of pain. When the foundry narrative weakens, the entire investment case requires reconstruction. On top of that, there are renewed indications that a key external customer, one of the hyperscalers Intel was counting on for foundry revenue, is expanding its commitment to TSMC for advanced packaging. Intel's foundry business needs anchor customers to justify the capital expenditure cycle it has already committed to. Losing positioning with even one major customer before revenue scales is a significant setback. The actionable insight here is specific. When a stock drops on elevated volume after a guidance ambiguity, not hard miss, but ambiguity, the market is rarely overreacting. Ambiguity in a capital-intensive turnaround story is priced more harshly than a clean miss because a clean miss at least provides certainty. Uncertainty about the timeline of a multi-billion-dollar bet is a different animal entirely. Now let's do something most finance content won't do. Evaluate whether the market's 5% reaction is proportionate to the actual information received, or whether emotion is doing work that analysis should be doing. Intel's market cap entering today was in the range of $90 to $95 billion. A 5.3% move represents approximately $5 billion in lost market value in a single session. That's a significant repricing. Is it justified? Here's the honest framework. To evaluate whether a single-day move is an overreaction, you need to ask 3 questions. First, does the catalyst change the long-term earnings model, or only the near-term narrative? Second, was the move priced in by sophisticated money before today, making today's drop a lagging confirmation rather than new information? Third, does the stock's valuation after the drop leave a margin of safety, or does it still require a perfect execution scenario to justify current prices? On the first question, the foundry timeline ambiguity is not cosmetic. Intel's entire premium over a slow-growth legacy semiconductor business depends on the foundry story succeeding. If 18A slips materially, the discounted cash flow models that assume foundry revenue inflection in 2027 and 2028 need to be rebuilt from scratch. That is a legitimate reason to reprice. On the second question, Intel has already underperformed the Philadelphia Semiconductor Index by a wide margin over the trailing 2 years. Some of this was known, but foundry customer risk was less quantified. Today partially closed that information gap. On the third question, this is where it gets interesting and where the not financial advice caveat really matters. At current levels, Intel is trading at a price to book that is near decade lows. That can mean value. It can also mean the market has correctly identified that book value is not going to compound the way it needs to. Cheap stocks stay cheap when the business model has structural headwinds. Understanding the difference between a value opportunity and a value trap requires honest answers to those three questions, not hope. This is the section that matters most if you want to become a sharper investor, regardless of whether you ever own Intel stock. What Intel's multi-year struggle illustrates is one of the most important concepts in equity analysis: the cost of losing a moat in a capital-intensive industry. And it plays out slowly at first, then rapidly. For decades, Intel's moat was architectural. They were inside virtually every personal computer and dominated the data center processor market. That moat was real, and it generated enormous free cash flow. But moats are not permanent. They require continuous reinvestment and competitive vigilance. Intel missed the mobile transition almost entirely. They underinvested in GPU and AI accelerator architecture at the precise moment that NVIDIA was building the infrastructure for a workload shift that would define the next decade of enterprise computing. And they lost process leadership to TSMC, which had quietly become the world's best contract manufacturer, while Intel remained vertically integrated. The lesson here is not that Intel is a bad company. It is that even dominant companies with real moats can lose competitive position over a 10-year arc in ways that are not immediately visible in the quarterly earnings reports. By the time the moat erosion shows up clearly in revenue numbers, institutional capital has often already begun repositioning, which is exactly why volume precedes price in these situations. For beginners watching today's 5% drop and wondering whether to buy the dip, understand what you are actually buying. You're not buying the Intel that dominated data centers in 2015. You're buying a company that is attempting one of the most expensive industrial turnarounds in semiconductor history, competing against TSMC, NVIDIA, and AMD simultaneously in a capital cycle that requires patient, long-duration capital. That is a legitimate bet. But it needs to be made with clear eyes, not on the assumption that a cheap price means a safe price. Price and value are not the same thing. And Intel in 2026 is the case study that proves it. We opened asking whether today's 5% was the start of a longer repricing or an overreaction. The honest answer: the catalyst is real, the structural headwinds are real, and cheap valuations alone are not a thesis. The next question, and the one we're going to dig into in the next video, is whether the U.S. government's semiconductor policy creates an asymmetric backstop for Intel that the market is systematically undervaluing. Subscribe so you don't miss that analysis.